Three familiar forces hit global markets this week, and none of them are new. Rising oil prices, stubborn inflation, and higher government bond yields combined to push stocks lower across the board. By the end of the week, equity markets in Asia, Europe, and the Americas had all finished in the red. Let's break down what happened and why it matters. Start with oil. Energy costs are a root input for nearly everything: transport, manufacturing, heating, shipping. When oil prices stay elevated, those costs ripple outward into the broader economy. Inflation stays higher for longer, and that creates a real problem for central banks, including the Federal Reserve, which have been working to bring price pressures down. The Fed and its counterparts have been clear. They need sustained evidence that inflation is heading back to target before they start cutting interest rates. High oil prices make that evidence much harder to find. Every week that energy costs stay firm is another week markets have to wait for relief. Bond yields added to the pressure. When investors sell government bonds, prices fall and yields rise. That selling picked up this week, and it reflects a specific concern. If inflation stays hot, central banks will keep borrowing costs high for longer. Bond investors are pricing that in. And when yields climb, bonds start to look more attractive compared to stocks. Money moves. Share prices fall. That chain of events, oil up, inflation sticky, yields higher, stocks lower, played out across every major region this week. That kind of synchronized decline matters. When markets in multiple continents move together, it usually means investors are reacting to a shared global concern, not a local one. This week, the shared concern was clear. The timeline for rate cuts may be getting pushed further out. For investors, the recalibration has been uncomfortable. Earlier this year, many expected central banks to begin easing policy by mid-year. Those expectations have been revised more than once. This week may prompt another round of adjustments depending on what the data shows next. The immediate focus now turns to upcoming inflation reports and any commentary from central bank officials. A softer inflation print could ease some of this week's anxiety. A hotter-than-expected reading would likely reinforce the pressure. Officials themselves have been careful not to signal any pivot until the numbers clearly support one. The practical takeaway here is straightforward. Watch the inflation data that drops in the coming days closely. If consumer price readings come in below expectations, that could shift the mood quickly. If they come in firm, or worse, above forecast, the pressure on equities and bonds is likely to continue. The data, not the sentiment, will set the direction from here. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.